Before we get started, let me read the emergency evacuation procedures. In the event of an emergency evacuation, an alarm will sound. Everyone should exit the building by way of the nearest stairwell in a safe and effective manner. If the nearest stairwell is blocked by smoke, use the other stairwell. Do not use the elevator. Once you have reached the main floor, follow the exit signs to exit the building and quickly proceed away from the building. Please be mindful of others evacuating and of emergency vehicles.
Okay, seeing none, the minutes are in your packet. If you've had a chance to review those, I'd entertain a motion to approve the minutes. Got a motion and a second. Any discussion? All those in favor of approving the minutes say aye. Any opposed? Motion approved. Item 5, discussion regarding the health fund. Jenny?
Thank you, Mr. Chairman. I would like to recognize our broker, Cole Harris from CBiz. He has a presentation that we will review. It's in your packet, and it will be displayed. Hopefully, those of you in the audience will be able to see it. If not, it is online.
Good.
We're good? Thank you, Jenny and Chairman. For today's purpose, really going over informational of an update. This isn't necessarily to get, again, into numbers, because as mentioned during the last meeting, it's going to take some time to get into a full recommendation. But as stated from our last meeting, we wanted to be able to present you more information so that when we do come up with a decision or a recommendation for the committee, that you have all the data needed and you can see the process as it goes along, because we do understand how important this is. So we're going to go over timelines, some of the claims. We were able to get some neat reports since our last meeting that I don't think you all have seen before, and I think it's really important to see where's your money coming from. Stop loss, and I'll get in some of these definitions. I know some of this is going to be insurance jargon. So if there's questions, please don't hesitate to ask. And then we'll get into some different ideas of the direction that we're going. Again, nothing in stone as far as where we're at. And also on top of this, everything is always changing. So if it even had some updates as recently as an hour ago. So I'll get into that as we proceed on. Okay, so first of all, what is our timeline? What's important? Because we have different areas of pressing needs. The first part is going to be July 1st. As we all know, your stop loss renewal is coming up, your fiscal year is ending. So we have two big players here that we have to focus on. Stop loss is the most important pressing need that we have to do right at this time. And I'll get into where we're doing, how we look in the stop loss in a moment. January 1st is the big stuff. This is where your ASO is going to renew, which is considered Humana. ASO stands for Administrative Services Only. What they do is Humana is they pay the claims on your behalf, so they pay the doctor's offices for you, as well as you rent their network, and you use them from a pharmacy benefit management system. So whenever you're using all of those pieces, and you used to have them for stop loss many years ago, so that was what was called a bundled package. The stop loss was moved over to a company called HM Life a few years ago, but everything else remains with Humana. So now what we're going to end up looking at is more of an unbundled approach, so of looking of how different ways we can peel away from Humana, and that's a good way to save in costs as well as not jeopardizing the integrity of the plan design. We'll look at carrier adjustments in terms of who makes more sense. Is Humana still a viable carrier? which administratively and from a report standpoint, I'd say there's people that are involved in this process, us included, that might see that there's other vendors out there that might better benefit what your needs are. Benefit adjustments, what that's going to mean is your plan design. We talked about this before. You have one plan design, which is a $500 deductible. There's opportunities, especially at your size, to have multiple plan designs, and I think that might be a better direction to take. Premium adjustments, as has been very public, we're in a dire need to make some adjustments from cost, whether that's premium adjustments from the county perspective, from the employee perspective, or from a fixed cost perspective. We have to look at all of this. You'll notice that all of these are areas that we focus on. It's not one piece of the pie that's going to fix your problem. We have to take it from multitudes of different areas, and you're going to find that each area is going to give us maybe 100,000 there, a couple 100,000 there. It'll add up to where we need it to be. You're not going to get everything that you need from one section of our area to focus on. So expected recommendations as far as when we need to have decisions. We'll have enough data for you so that you can make a decision on stop loss by early June. The end of June is when we've already sent out to market on all of these areas as far as, and when I say out to market, that means we sent out quote requests for all of your different benefit needs, ASO, stop loss, your work site, which is going to be your voluntary products, your dental insurance, life insurance, disability, everything. We've already sent that out. Pharmacy benefit management. Thing is with health insurance and all of these different benefits at your size, there's a lot of data that's needed. So it does take some time, but we hope to have by the end of June, beginning of July, some data that we can come back to you with and state that these are some areas that we might start making as recommendations. Because ultimately, the required decisions, you need to have a required decision in place for stop loss at the end of June. End of July, beginning of August, we have to have everything nailed down from your benefits, because you're going to be up on to where we're doing employee meetings, ideally by the end of August, beginning of September, and then your enrollment itself in October. So then everything is clean and clear for a January 1st effective date. So let's get into some of the claims. This is the exciting stuff. So let's focus on, this is a really good overview of the past 12 months. We broke it down from active employees, retired employees, and then retired dependents and COBRA. So the difference between the retired employees and retired dependents, right now the way that the benefits work, and you may or may not be familiar with this, is your retired employees are treated just like your active employees. Whenever a retiree becomes age 65, they are no longer able to participate on the health plan, but their dependents can stay on until they're also age 65. So that's why we have it broken down from employees and dependents. You might have dependents that are on your plan right now that the person that was the employee here is no longer on the plan design. Your active employees are obviously who are currently employees, and then your COBRA are those that were employees that decided to take the COBRA but didn't qualify for the retiree benefit. Also the reason why you have such a few amount of people on COBRA. Your average monthly claims for each division, for your active employees, you're averaging around 1.37 million per month. Your retired employees are at 114,000. Your retired dependents are 41. So cumulatively between those two, you're looking at right around $155,000 per month on a retiree class. Your COBRA isn't much. You're at 2,046, which is a bit of a surprise to us when we dug into it. Your COBRA classification usually is going to be your higher end users, because usually you're not going to take COBRA unless you really need it. And especially in today's environment with healthcare reform, you have the exchange out there. So usually people are better off going on the exchange than continuing with COBRA unless there's a major medical condition. So it is very surprising to us that you had such few amount of claims given that area. So annualized claims you can see at the bottom. So then let's get into department. This is something that I don't believe you all have seen before, and I think it's important to see where the claims are at. The Board of Education, your active employees, so you see out here, this might be a little confusing. Under one column it says active employees. If you look at the row out to the left, you see it says number of members, and this was something that we brought up the last meeting. This is a definition type of area that you have to be familiar with. In insurance language, members is considered the same as what we call belly buttons. So if you have a belly button, you're considered a member. That's going to be a child, a spouse, a parent. Anyone is a member. So while it says 2,600, that doesn't mean you have 2,600 employees or subscribers. So employees and subscribers are synonymous of one another. Members are going to include every person within that family. So for this purpose, the number of members that you have on Board of Education that are under the active employee is going to be 2,607. Your average per member per month cost, and this is what I really focus on because I think it's very important, is $393. The reason it's important is because then it takes out the number of employees out of the equation. It doesn't matter because then you can really see where your claim's coming in. Board of Education is obviously going to be your highest count, but you might look at the Sheriff's Department or Highway Department and see that they have fewer counts, but may look at the average cost per member. The retired employees, this is where it really is going to stick out to you guys, is your retired employees, you have 165. Average per member per month cost is $557. Retired dependents are at 61, $568. You'll see this is a common theme, and this is all as of March 31st for the numbers. The general county employees, you're at 392. Your per member per month cost is at $294. So again, to give you perspective, you're at 393, we're going to 294. But look, your retired employees. This is going to be a skewed number though because of our count. You're at 10 employees, but you're at $1,216 per member per month. And then the retired dependents at $1,600. I mean, you could have 10 outliers in this equation, so it's kind of hard to define what that really means with such a low population count, but it's still important to note. Let's get into the sheriff's office. You're at $269 per member per month of 641 active employees, which is you can see they're doing very good from a claims perspective. Your retired employees, you're at 342, and then retired dependents, you're at 152. Library, this is the only outlier out of the whole equation, that 38 active employees. We actually do have one retired employee in the library side, but they were misclassified in general county. So, but based on the report, it shows as retired employee. We're going to get them moved over into the retired employee of the library there shortly. The active employees, the 38, your average per member per month cost is a whopping $1,100. It's, again, such a small population count, one person could be accounting for the majority of those claims. Your highway department, you're at 104, and you're at $285 per member per month. So what you should be seeing from this is an average should be between $220 and $350 is where your range is for active employees. But then your retired employees, your range has been between $550 to close to $700. So a drastic increase, more than double what your active employees are, retired dependents as well. And then your COBRA, you have 7 employees, active per member per month cost of $528. Dependents are only $111. The dependents are the surprising part. Usually the dependents are the expensive one when it comes to COBRA. So again, it's such a small population, it's hard to really address your COBRA side of it as being something that we can save a ton of money on. So some takeaways from this. Your active employees, the average per member per month, or per member per month is really what that should say, is $363 per member per month. Your employee, the retirees that were employees are $579, and then your dependent retirees are at $530. I did these as a weighted average, so I'm not just taking your library. Your library would have skewed that up if I just took the 4 categories. These truly are what your averages are, and then your COBRA is at $239. Your retirees for the average annualized claims are $1.8 million on average, and the reports that we get are over a 24-month period of time. I did my averages off of 12 months though, because it's really your last 12 months at your size that's going to be credible data. Usually if we get into smaller counties or cities, you'd use 24-month period of time, but you have plenty of members and employees to use 12 months from a credibility standpoint. Your expected revenue from the retirees, this is what I thought was really striking to me. And when I say revenue, this means what the retirees themselves pay the county for their health insurance is going to be expected around $101,000 over the course of the year to pay claims of $1.8 million. Your total funding then from Blount County comes out to around $1.5 million for that classification. Again, as I mentioned before, retirees are considered just like employees for those classifications, so they're paying the same cost as what employees are. This is an area that I think we have some opportunity if we do any kind of recommendations. It is normal, if you check in the surroundings counties and cities, that the retirees pay or have a heftier portion than what they do here. Also something that I think will help out, and as we're getting, our actuary is going to have more of a final recommendation here shortly. One of the areas I've asked him to break it out is right now all of your funding is a big pool. So all of your funding bases is including the retirees and the active employees combined. What I've asked him to do is break that out so that when you are doing your budgeting process and your funding mechanisms, you have a different segment for the retirees versus the active employees. And I think that will really give you a better idea of where costs are, as well as to better fund for it. So when you have a retiree come out, you're able to fund that retiree's claims better because we know that they're going to cost more than your active employees. Whereas right now, when you have a retiree come on board, your funding is attributed to the same as an active employee, and it's just not working. With as many retirees as you have, that adds up quite a bit. So let's get into stop loss. Stop loss can be is always a question: is what is stop loss? Stop loss is considered your reinsurance contract. What does that mean? That means right now you're a self-funded plan, but in reality, from a technical standpoint, you're considered a partially self-funded. That's because you have a stop loss contract on top of your self-funding. That means that the maximum exposure that you have per individual on your plan is $250,000. After you have $250,000 in claims, your stop loss carrier, which is they're called HM Life, picks up any of the excess claims. So to give you a perspective, in 2014, during your renewal, and this is the hard part too, is your renewal is a July 1st, but your plan year is on a January 1st. So that does play into some issues. So eventually our goal is to make those sync up. Whether it be a January 1st or a July 1st, we need to eventually have those synced up. And also take into consideration that whatever we do in January, we can get adjustments on the stop loss for January. Because ultimately, if we end up going with a different network, and that's going to be where you could get some savings, if we find a network that's better than Humana's network that provides greater cost savings, then that's going to lower your premiums on your stop loss. So whatever we lock in for July doesn't mean that's going to be what your overall contract is going to be for the next 12 months. It could adjust in January, so just keep that in mind. So in 2014, you had a 9.6% increase off of a 108% loss ratio. Definition of a loss ratio is the amount of money that is brought in from a revenue perspective to the amount of money paid out in claims. And keep in mind that 100% does not mean dead even. So in this perspective, from that example of 108% loss ratio, that means for every dollar brought in and for premiums, they paid out $1.08. And keep in mind that they also have administrative costs within the carrier. So it's not as simple as saying that you lost 8 cents on every dollar. You actually, usually a good benchmark that insurance companies use is 85%, and that's also tied to what the healthcare reform law states as well, that your break even is 85% for a loss ratio. Anything in excess of 85% is considered a loss to the carrier. Well, let's jump ahead to this year, from July of 2014 to July of 2015. Keep in mind that today is only May 18th or 19th, one of those days. So with that in mind, we're having to make some estimates. So that's why I'm saying estimated. We're estimating that your claims, make sure that We're estimating your claims to be at $973,000. It's going to be anywhere from $825,000 to $975,000. You do have two very large claims. One is still ongoing that combined are well over $1 million. So there's one that is still in the hospital, and that's been going on for quite some time. That is going to be a very hefty claim. Your initial increase is at 45%, and then we did get them down to 40% with. So the way it says on here, your 45% increase amounts to an increase of $277,000. Your 40% increase amounts to $246,000. It says potential lasers. So definition of a laser is stating that if you had a major claimant that they expect to be ongoing, instead of saying that your stop loss for that person is $250,000, they could actually say that stop loss for that one person is $500,000. That means they're lasering out that one individual. I know no one can say that, that's fair, but unfortunately that's the world we live in with stop loss. They can do that on an annual basis. I did speak with their carrier yesterday, and they stated there's not going to be any lasers if we stay with HM Life for this year. But if we stay with the 45% increase instead of doing the 40%, what they're going to state is they will put in writing on your contract that they guarantee your increase next year can be no greater than 40%. And the lasers included in with that. So why that's significant, as you see at the bottom, we've sent out to 12 stop loss vendors. It says here 9 have declined. I'm up to 10 that have declined to quote because they're coming in at over 100% cost increase over what your current rates are, given your current claims history as well as the projected claims. Oddly enough, we've been beating on these carriers to give us something. An hour ago, I happened to get a rate quote from HCC. Their quote is coming in at 37% instead of 40%. So we do have something at least finally that's come in more competitive than current. That doesn't necessarily mean that HCC is the way to go, but that gives me some negotiating power to go back to HM Life and try to get these rates down. And if we can get HM Life down and have a guarantee on the renewal for next year, then that's a win-win. Also, something else to look at, and we looked at this, right now your stop loss is at $250,000. If we go up to $300,000 instead of $250,000, then that actually gives you an annual premium savings of $200,000. All right? So that is a positive. The negative, though, is every time you have someone exceed $250,000, that's going to eat into that savings. So if you have 4 people exceed the $250,000, then you're break even. You're at no difference. When we did a review of your past 2 years, you've actually you've not had a year yet where you've had 4 or more people exceed $250,000. So given that data, we do think it'd be a good idea to go to the $300,000. And knowing that at 4, you're just no worse off than you would have been under the $250,000. But at least if you're at 3, then you save at least the $50,000. That's going to be with HM Life. HCC, their $300,000 doesn't make sense. So each vendor is going to have different cost factors for that piece of it. So your pharmacy, it's currently bundled with Humana. What this does whenever it's bundled with your ASO carriers, it is very difficult to get a lot of the data as far as how much we save and different factors because they do bundle everything. The plan paid out around $4 million in pharmaceutical costs as of April 30th of this year. In January 1st of 2015, we added what's called the pre-authorization benefit, or your previous regime added that part of it. The pre-authorization benefit, what that means is, I'll give you a perfect example. Can't think of the drug name, but with one of our other clients, the new hepatitis C drug that just came out, that costs $30,000 per dose. For that person to get that medicine, they had to go through a pre-authorization period. That particular person was declined 4 times until the doctor could get enough data showing where it's absolutely a medical necessity for them to take that drug. That particular instance, he was going to have a liver transplant if he didn't take the drug. So liver transplant, even though you're looking at around $90,000 in claims from a drug, is still a lot less expensive than, potentially a $500,000 transplant. So in that case, it worked. But that's where the pre-authorization is important, so that you don't have people taking these high-cost drugs where a lower-cost drug might still be the best policy for them. I don't have a report yet as far as how much that has saved year to date, but it does say, and I think that number is mixed up, that they expected around $82,000 in savings for the pre-authorization benefit. The step therapy benefit for the prescription, what that means is that you have to try other drugs before they'll approve you for this one. So it's stepping stone. A common prescription for that would be like your cholesterol, blood pressure medicines. This does cause a disruption to the employees whenever they're taking their medications. If they're used to taking a brand name drug or a higher cost generic for the blood pressure or cholesterol medicine, and then the step therapy states they need to take a lower cost or have a doctor prove that they've tried it and it didn't work. But they are projecting on this, and that's a misstatement on the slide, of around $200,000 in savings. You did not implement that last year, probably from the disruption that could have caused from it. But if we're looking at savings, this is something that almost all vendors are doing across the country. And even, if you're looking at cost controls, this is a really good way to do it. And then we also want to look at moving to a different pharmacy vendor. We've sent it out to 11 different pharmacy vendors. What this would mean, the only negative would be that there'd be a separate ID card for the employees for the pharmacy. So that you go to the pharmacist, you just have to hand them your pharmacy card. There's a lot of companies out there that's how it occurs. There's one way we could get it under one card, but that would mean that we'd use what's called a TPA instead of an ASO. That stands for third party administrator. Where they just can do an unbundled process a little bit better. The advantage to it, though, is there's more transparency, there's going to be greater discounts, as well as rebates. So right now, what you're kind of lacking, for better words, is going to be the pharmacy rebates. And what that means is every time someone uses a brand name drug, there could be a potential where that manufacturer sends a rebate back to the county to offset for some of that cost of the drug. Right now, you're not really getting that, and that offsets on the admin costs. So this past year, you've had no rebates. For perspective purposes, I have a client that has only 80 employees on self-funded. Their rebates for the last quarter are around $3,000. So it offsets the admin costs. It can be a good benefit. But that doesn't necessarily mean you're getting a bad deal with Humana, because their discounts could be of such that it offsets for that lack of rebates. Whenever we go through this full review process, we'll have a better idea of what that looks like. So medical benefits, you're currently, just to give you a replay of where you're at right now, you have a $500 deductible, $1,500 out-of-pocket maximum. Obviously your municipal or county or city governments, the health insurance is what is a great benefit to be an employee here. As far as commercial market, your average deductible is $1,500, edging closer to $2,000 in the commercial market. And those would be even your blue-collar employees that might make closer to minimum wage. Right now, you do have 3 different tiers. One is the 90% tier, which means that if you go to the Blount Preferred Network, you get a 90% coinsurance. If you go outside of Blount County's network, it's going to be 80% coinsurance. If you use a non-network provider, it's 50%. This is also a very strong benefit. You have a $50 copayment for emergency room, which is incredible. Office visits do go towards your deductible. So once you meet $500 of your deductible, then your doctor visits will be covered. But keep in mind that you do have the clinic, the East Tennessee Medical Group, that is covered for your common illnesses and such. From a prescription, you have $10 copayment for generics, 30% coinsurance for brand name drugs to a maximum of $60. This is also a very, very rich benefit. So what I'm going to propose, I'm not going to give you specifics as to what I'm going to propose, because what I want to do is we're going to use our actuary and give you true numbers as to how this could save money based and play with the deductibles and figure out what makes sense compared to your other city, county governments, as well as, we don't want to just change a plan design but not see enough savings to where it makes sense. And we want to keep it as least disruptive as possible. Right now, I think that at your size, 3 options make sense. And one of the options that you're missing right now that a lot of companies have, and even city and county governments, is a qualified high deductible health plan with a health savings account option. This became a plan design back in 2004. Under the Bush administration, they created health savings accounts and health reimbursement arrangements. Every year since then, they've created different pieces to make this more and more attractive. A lot of people will compare a health savings account to a flexible spending account. All right, a flexible spending account and health savings account, while they're very like in certain areas, they're also very different. You do get a debit card for a health savings account, and as you can see, this isn't just a stunt. I've come prepared with bandages. I just used my health savings account card yesterday, so it looks just like a bank card. And so the advantage with it is it rolls over year to year. I didn't anticipate having any kind of medical issues. A flexible spending account, you lose it if you don't use it. You do have a benefit on your flexible spending account that you can roll over $500, but with a health savings account, you can roll over the entire amount. So for me, I've been using this plan since 2006. I've built up enough money into my health savings account to where I was able to have a procedure, and for me, out of my own pocket, I don't consider this my own pocket because I can only use it for medically qualified expenses. It's been sitting there. I'm able to pay for my entire procedure out of it and not affect my own personal budget. So I love the plan. The negative to it compared to the flexible spending account is your money isn't available up front. So if I have a procedure on January 1st and this is my first month in it, it's not going to cover it. You're not going to have money in there right away. But you can pay yourself back over time as you build it in. The advantages to doing that is you get pre-tax money by doing so. The other negative is the only way you can have this account is if you're paired with a qualified high deductible health plan. Whereas your flexible spending account, you can pair it with any health plan that you want. A qualified high deductible health plan means that you have to have a deductible in excess of $1,300, but the most common is a $2,700 deductible for this type of plan. And everything accumulates towards that deductible: prescriptions, doctor visits, everything. But the advantage is that you're going to expect a much lower premium. So the idea behind this is you take that difference in cost and put it into the health savings account. This is a really good plan for those that either have a lot of health costs or those that don't have any. So you might have some healthy individuals that never use their plan design that would rather have the cost savings, or you have some that have a lot of health conditions but could really benefit from the pre-tax benefits of the health savings account, as well as many of us probably have the same belief, this creates more of a consumerism atmosphere, which is going to be better for your overall claims perspective, because now instead of going to the emergency room for a cold at midnight, you might wait till the next day because it's going to cost you around $700 under this plan versus going to the doctor visit, which would cost anywhere from $70 to $80, if not less. And option 2 would be kind of a middle tier, I would project, meaning that you might have a higher deductible but have copays for doctor visits and prescriptions. And then option 3, I'd want to, not to sound like if you like your plan, you can keep it type of mentality, but this allows you that if you do like your plan, you could keep it. If you have option 3, we just might adjust the cost contributions for it. Down below, we're looking at wellness and telemedicine. We have an on-site wellness coordinator. She is looking at your plan as, probably not as we speak, but as we have been speaking. And she has a lot of experience in it. My company has a lot of experience in it. We have a client that just won the Eddington Award for wellness and for all of the things that they've done. Wellness is not something that you do everything overnight, though. So if you have these grandiose ideas of let's throw all this stuff at it, it's not a good idea, but we can step it into it. This is something that wellness is going to contribute to the overall health of Blount County's fund over time. It's not something that tomorrow it's going to be a cure-all type of thing. It is it's a very good idea to go in this direction. A non-tobacco discount is the first thing that we might want to consider. This means that if you don't use tobacco, you get a discount over your plan design. So it's a really common thing. Also, Teladoc is a great thing to add to your benefits, but I would offer it as a voluntary option so it doesn't cost the county anything. I personally have Teladoc. I love it. What that is a telephonic physician service 24/7. So you have the clinic available, which is great, but the clinic isn't available 24/7. The Teladoc, for me personally, I use them, like I said, I had surgery on yesterday. On Friday, I had an upper respiratory infection. You kind of hear my voice, but on Friday you couldn't even hear me talk. Well, I had to get something quick, didn't have time to go to a walk-in clinic, had a lot of things going on, and also have that HSA account. Well, through the Teladoc, I'm able to talk to them. They can tell I have an upper respiratory. It's only for common illnesses. They're able to prescribe me a medicine over the phone. There's no consultation fee. With the advantage to that, that means it doesn't affect your claims from the Blount County side as well as from the employee perspective. It saves them time and money. So it's a really good benefit when you don't have a copay for your doctor visit. The overall cost to the employee at max, and this covers the entire family, is $8.50 per month. The other big advantage, if the family has kids, they can write a doctor's note over the phone for it. It's an awesome benefit if someone uses it and can really have some long-term cost savings. The state of Tennessee implemented telemedicine for the TennCare population for the rural areas back about 3 years ago because of their lack of accessibility to providers. So it's something to consider. So the last session we talked about, what about the state plan? The state has a plan, why don't we jump on it? Well, there's some positives and negatives. To the county, it would be considered kind of like your fully insured platform, meaning you'd have a fixed cost. You don't get the benefits of self-funding whenever the self-funding benefits you, but you also don't have the cost fluctuation. There's no plan flexibility, and the state plan is much more rigid than your plan design. So keep in mind when I go through these things, if we were to match up on some of this stuff to your plan design, what the state plan does, that automatically is going to save you on your overall costs. So while it's good to consider the state plan, it's not necessarily something that you may want to jump in that direction. The first part is you have different options. You have partnership, standard, and limited PPO. The partnership plan has a required participation in wellness activities for both employees and spouses. If you do not participate in this, your costs go up significantly from a cost contribution standpoint, and not only your costs, but your deductibles go up, co-insurances and everything. So your deductible from the employee is $450, for the family $1,150. Out-of-pocket expense, that means your maximum that you could pay out-of-pocket is $2,300. Under your current plan is $1,500. Your co-insurance is 90%. You have a $25 and $45 copayment depending on the type of provider. $125 for your emergency room, and then your prescriptions go all the way up to $85. So you do have some negatives there. What does that mean for the wellness activities? It means it's a mandatory health risk assessment, so you have to fill out a health questionnaire. After that, if you are deemed as someone that needs health coaching, then they will require you to participate in health coaching. This is a dramatic change from where you're at right now. This is something that I would like to see us go in that direction at some point, but if you just rip off the Band-Aid and go this direction, it could be a huge disruption. But something that we'll take into consideration when we're looking at different plan options. You have to do tobacco cessation and or case management and screenings, biometric screenings. Biometric screenings mean that every employee that participates in this plan would have to get an intravenous or a blood draw, and they do a blood panel to determine where your health risks are. So what is the standard plan? The standard plan means you don't have to participate in those health risk things. Your deductible jumps up to $800, out of pocket to $2,600, co-insurance to 80%, and look all the way down, and your prescription goes to $95 for the brand name drug. So emergency room jumps up to. The limited plan, your deductible goes to $1,200, out of pocket to $6,600. That is the highest maximum you can have under the letter of the law with the Affordable Care Act. Your co-insurance is at 70%, doctor visits jump up, emergency room at $165, and then your deductible, you have a prescription deductible of $100, meaning you have to pay out $100 in costs before your copays kick in. Then your copay is at $1045, $95. So whenever I say your estimated costs, I'm basing it on the standard plan with the state, because that's most like from a structure standpoint where you're currently at, but it's even worse than the plan design that you currently have. Based on the standard plan, if you had all of your employees in that, your total cost would be right under $21 million. Based on your current funding mechanism in place, your estimated cost based on your current plan design is at $18 million. So while it's good to keep in mind where the state is at, I'm definitely not recommending at this time going to the state just because of all the restrictions, plan designs, and your overall costs are going to go up by doing it. Whereas we can have your costs go down if we make some plan adjustments. Dental insurance. This is another thing that dental insurance is very popular with employees. It's a great perceived benefit. It can be a good actual benefit. You're currently fully insured through Blue Cross Blue Shield. Your estimated annual costs for active employees are at $943,000. Your retirees are at $83,000 for a total cost of $1.02 million. How that breaks down is the employees pay $511,000 of it because they pay nothing for the employee-only cost, and then they have a portion that they pay for family. So the $511,000 is just going to be the family coverages. Your Blount County cost is going to be $515,000. So when you're looking at that, one of the things that you want to think about is what can we do from a dental insurance? Because $515,000, that's a lot of money. So what we look at is, let's look at fully insured through a different vendor. It is nice having it to where you have a budgetary standpoint. So there are some other options outside of Blue Cross, but right now this is going to be a great leverage piece for us. So if this is a piece that we can use for our medical vendors, they love to have this as a package option. So when we look at dental insurance as well as life insurance, everything else, we use that as a negotiating tool to drive down our costs from a bundling perspective. Then we also want to look at, well, 2,000 employees, you should really look at self-funding for your dental. And in reality, at self-funding, to keep everything as is, I'm estimating that you could see a cost savings of around $100,000 for that. So that might be a viable option. The voluntary, though, that is something where a lot of companies and county governments, everyone is moving in this direction. Voluntary means the employees pay the cost for the premiums. So if the employee doesn't want dental insurance, they don't have to take it. The advantage with having a cost to the employee, so at the very least, if we change the contribution from being $0 to 5 or 10, and I just met with some people last week at a bank client of mine that one of the people that work in the office, they don't pay anything for their health insurance or dental insurance. The employer pays all of it. She said that her husband, she carries her entire family, even though her husband and son both have health insurance on their own through their own employers. I told her that they currently have a high deductible health plan, so there's no benefit in doing it. She just thought there was a benefit in having 2 insurances. Well, that costs that bank around $800 a month for her to do that, and there's no benefit. But because there's no cost to her, she's doing it. So inevitably, and you found this when you created some cost contribution on the health insurance, that your employee population participation on the plan dropped a little bit. A good reason for that is because they may have already been covered through a spouse or through some other form of insurance. So of course they're going to take it because it doesn't cost anything. But if they do have to pay out of pocket, there might be an advantage for them not to take it if they already have health insurance, and it might actually be better for them in those cases and some of the dependents, because it can hurt them from the way that the 2 insurance talk to each other. So if you look again back to the other slide, with the Blount County government paying $515,000, if you go to voluntary, Blount County saves $515,000 in cost. So when we're looking from a budget, that could be one way, or you don't have to go to that extreme and just have the employees start paying a portion of the cost. Even if it's a little bit on the dental, it's going to save. If for nothing else, your participation might go down a little bit for those that are already covered somewhere else. Dental insurance, you see, we sent it out to 22 vendors on this, so I anticipate we'll have a very good competitive market for dental insurance. It is already competitive whenever I did a quick sampling of 3 or 4. So we're going to have some options for this in January. So employee contributions to the benefits. What we're studying here is going to be the impact of adjusting payroll contributions, and this could be from a multitude of different areas, whether it's multiple medical plan options. So again, if it makes sense to offer 3 plan designs, maybe we have one plan that's the same cost as is now, but then offer the 2 other plans at a higher cost. So you have employees that if they want to have their same cost out of their pocket, they can, But if they want to have more of a Cadillac option, they can still do that, but they're going to pay a little bit more. What that creates is all of a sudden you have a situation where the people that are going to use the medical benefits, which is going to cost the county a lot more money, will be the ones paying a little bit more out of their pocket. And those that are, unless they have something unexpected happen, for the lower plan designs, they will pay less out of pocket, but their deductibles might be a little bit higher. Dental insurance, will study the impact of changing payroll contributions for that. And then your retirees, that might be a strong area that we want to consider. How can we make this to where it makes more sense from a cost standpoint and to get more in line with what the rest of the area is doing? So before I get to that point, we have a lot of different areas that we're addressing. I'm hoping by the next meeting I have a lot more actual dollar numbers I can give you. As I mentioned, our actuary is going to have a recommendation for funding levels. I spoke with him on the way here today. He says based on some of the numbers, we may not be as bad off as we initially expected if we make just even funding plan changes from the retirees to the employees. But we have a lot of areas, as I hope you can tell through this presentation, that we can attack your overall financial state of your plan design to where we can make this more, it's more viable. Right now, the option of not offering health insurance is something that can be realistic if we don't make some changes. And I know it's hard to make changes, but now's the time really to do it, and we want to do it in an equitable way across the board from employee, the county, and obviously the taxpayers as well. So, Commissioner Casca earlier in the presentation went into some of the claims based on the different departments. I know that was something that you wanted earlier as well, so I hope you have a chance to review that as well. Are there any questions you might have?
Any questions from the committee for Cole? Mr. Caskey.
Mr. Chairman, I apologize for being late. I was just running late. No excuse. I do have a couple of things. If you're going to come back with more numbers, I'm still having a really hard time getting to where you are on some of your numbers.
Okay.
The claims, and I'm not just pulling figures out of the air. I talked to a statistician today and a math teacher at one of the high schools, and I asked him, how do you do trends? How do you do projections? And you got to use some data points. You got to have data points. I don't know what your data points are. I was looking at some of the information that you gave us, and they're kind of interesting the way that you chose a certain segment of time. Why aren't you going with the fiscal year? Because that would be a lot easier for us to understand if you're going from July the 1st to June the 30th, but you're jumping around. One time you were in September to another time. That's very difficult to keep up with. Your fund balance that's where I can't even get a straight answer on the fund balance. I went by the trustees report, and I'm counting on the trustee to be correct.
Yeah, and the fund balance, that's not in this presentation. We are meeting with the actuary later this week, where I am, and we're going to be discussing where they're at. As you all, through the Finance Committee last week, those numbers are all on the fund balance. I can't speak to that part. That's held at the Blount County. What I can speak to is the claims. And the claims, the numbers that I use from the claims is your numbers. Those aren't projections. Those are actual physical numbers. And the reporting periods are just based on how the carrier does the reporting periods. You can't have a year-to-date on the reporting period because it takes time from their system. It doesn't go, I can't pull a report saying, as of today, these are your claims. Just from a lag time standpoint and a paid out standpoint, you have to generally do that from a few months back. But if I go from a July to July, then you're missing all of this past year. And I don't want to project out from April of this year till July. I'd rather use actual claims numbers. So with the majority of our claims that I'm basing it on is going to be as of March 31st of this past year. There will be some, if we get updated reports, that will be through the end of April, that will be used. But the thing that is of significance here is that is your actual claims numbers. So in speaking with a statistician or anyone else in the industry, that's fine from a projection standpoint, but when I'm going off of your actual data, then there's no arguing the data from a claims standpoint. Those are your numbers. And you do have high claims as of the past 12 months, and they've been increasing from prior 12 months and the prior 12 months from that. And your stop loss has increased significantly from the claims that are attributed to the stop loss, and that's a direct indicator of your overall claims picture from that perspective.
Well, not according to the reports. They haven't.
The reports from Humana are breaking down exactly what your claims are paying out. If you're looking at any other reports besides from Humana, then those are invalid to you.
So Humana is correct, and the trustees' reports and the financial reports we get on a monthly basis are incorrect. And
If they don't match up,
report is incorrect.
I can't account for what the trustees' reports are or any of those reports. I can tell you that Humana is one that pays your claims. So those are the claims that are paid out. Why there's a difference is because when someone goes to the doctor's office or to the hospital, that it takes time for that payment to actually get paid out. So if there's going to be a different number from the trustee side, that's going to be, I would imagine, what they have actually paid out from the county. The report is going to capture the actual claim itself. So even if it hasn't necessarily been paid out directly, your county is going to be where it's paid out.
I understand that, but at some point during the year, it's going to catch up.
It will.
And
but
when you end up at the end of the year with a fund balance that's different than what you're showing, then there's something there. And you mentioned March of 15. You had estimated the claim at 1.6 million. The actual claims are 1.2. So
What
you
number
missed
are
that
you-
one by $400,000.
What are you referring to my presentation?
Well, I'm not talking about your president. You're talking about you're going to come back with more figures next time. These are some of the figures you need to come back with next time. It's some hard evidence. You're asking us, and we're going to be deciding in June whether we want to ask the public to come up with 16 cents to fund something, to fund a guess. Right now, I don't have any hard evidence that would make me want to support that.
Now, what
And
are
I
you
will
saying as
argue
of March?
against it.
What are you saying as of March? I'm sorry. That you're saying that I'm telling you the cost is?
Okay, and the March and the little thing that you did last time.
Okay.
And
If you don't mind that report that I said last time,
Probably not any good anymore, is it?
if you recall from the very beginning, it said this was a draft. That was based on 2 weeks worth of work, and that 2 weeks worth of work is normally something that takes 2 months. So this gives you an idea of where we're at, not an actual, and that's where our actual will be in place by the end of this week, potentially next week. So that was a draft, and I stress that because a draft is not going to be in force. And that's also we have a lot more reports that we've been given in the last 2 to 3 weeks that will better support what we end up with.
And in a couple of minutes, you'll also see information that's in this packet that compares April claims to revenues as well as year-to-date information. Those numbers are, as Cole said, they are what they are. They're actual because they're numbers that we've already experienced. And we'll talk about those in just a minute. You'll be able to kind of grab some information from that. Commissioner Stennett?
Yes, thank you, Commissioner. Cole, 2 things. First thing is, statistically, trying to change a program over 12 months, I don't think's very smart for us to try to even consider. I think we need to go back 2 or 3 years and see the trend. Second thing, explain to me again the stop loss, how they're getting around the $250,000 stop loss that we were paying for.
So let me just make sure I understand the question. So with the stop loss, are you asking how the stop loss functions, or?
No, I understand how that functions. You said a few minutes ago, 30 minutes ago, that somehow, for instance, we have someone who's got cancer or something, and they get it $250, but somehow it ends up being $500 stop loss.
Okay, I understand what you're saying now.
Explain that.
Yeah. So they do it at the beginning of the stop loss contract year. So if it's not in place, it's called a laser. And so what that means is if at the beginning of the stop loss contract, as of right now, you have no lasers on your plan. So that means anyone, no matter if they have cancer or anything, it's going to cover after $250,000 is paid out. In future years, if they deem that there is a high cost claimant that they anticipate, can actually place a laser on that person, but it has to be at the beginning of the contract year, so it'd be July 1. They don't anticipate it being this July, but if you have some high claimant in the future years, they can make it next July, stating that it would go from 250 to 500 or 600 or whatever that stop loss contract deems appropriate for that particular person. But they can't do it willy-nilly in the middle of the year. So it's not going to be something like someone comes down with cancer and they're not covering it at 250. It has to be within the actual policy year from July to July.
Cole, would they basically look at, because they've got all that information, so they would laser somebody that possibly had very high claims the previous year and see if that's a continuation into the next year, or how do they decide to laser someone?
They don't necessarily look at just high claims in the past year, because that's not an indicator of what they're going to pay out in the future. So you could have someone like the few high claimants that you have right now, they're not putting lasers on them because they don't anticipate a lot of claims in the future for those particular issues. But if you had someone that, let's say they were diagnosed with a very bad disease as of like May 1st, and they see that before the July 1st, let's say like an autoimmune disease that costs hundreds and hundreds of thousands of dollars, they might decide to place a laser on that particular person because of they seeing long-term ongoing claims with them. Now, there's always a way to get around the laser. So how you get around a laser is you essentially pay more in premium. So if you pay more in premium...
Say it again.
A way around a laser is you end up paying more in premium. So either what you have to look at is, does it financially make sense for us to pay the higher premium to have no lasers, or to pay lower premium but have a laser or two on it?
So it's something we're purchasing.
It's something that you're purchasing, correct? But at this time, let me again restate it, you have no lasers. You're not going to have any lasers for this next year either. So you have at least 12 months of not worrying about that. The only reason for bringing that up is that if you, as of the current vendor, as of where we're at right now, negotiations, if you pay the higher premium, they'll guarantee next year where you'll be that you can't be higher than what they're stating without lasers.
So we're not... That is nothing to us as of right now.
As of right now, it's not something that you need to worry about. The only thing you have to worry about with that is when you're deciding if you want to pay, if we had no other options on the table, if you wanted to pay the 45% increase or the 40% increase, the 45% increase protects you against lasers next year. So not July of this year to the next year, but of July of 2015 to 16.
So you either get 1 year or 2 years. You pay the 45%, you're guaranteed another 12 months.
So next year, what that means, if you pay 45% this year instead of 40%, they guarantee that your renewal next year will not be greater than 40%, no matter what your claims history says, as well as meaning that they'll protect you from lasers next year. So for the 5% differential, it might make sense to do that. But we're also, as I mentioned right when we started, with our new competitive bid that we got in an hour, or I guess 2 hours ago, that gives us some leverage finally, since to date we haven't had anyone come back with a bid, period. So now we have someone that has come back with a bid, so that gives us an opportunity to get your current vendor lower.
Thank you. You did not respond to going back 3 years.
Oh, yes, from a claims perspective, we have that data, so I'd be more than happy to show you a chart showing you from the past 3 years on the claims, and I'll be sure to bring that during the next session.
Any other questions?
And there'll also be, at least the last 24 months will be in when we have the final report from the actuary. We'll have that data in there as well.
Commissioner Caskey.
Mr. Chairman, is that going to be calendar year or fiscal year?
For the actuary report, I'll have to double check. I can't tell you at this point on that. The reason why a lot of them are going to be plan year or calendar year is just because that's when your actual plan goes. So I know that can be a little confusing from a financial standpoint, but when you look at your overall utilization of your plan, you wouldn't go from a fiscal year because that's not how your deductible year runs. So your deductibles and all the financials of the health benefits change over as of January of that year. And when you make plan changes, that's going to be reflected from January to December, not July to July. And that's where hopefully at some point we can sync that up to where your plan year and your fiscal year are married. And so you don't have those, the difficulties of having to project out what your costs are going to be during the next plan year. That's something that we are actively trying to get on, but unfortunately there's no way to do that for July of this year, but that is something that's plausible for July of next year.
Okay. Anyone else? Cole, thank you very much.
All right, thank you.
Okay, next item is discussion, or the reporting, budget report as of March 31 that was presented at the budget workshop. Jenny?
Thank you, Mr. Chairman. Before I do that, I do want to provide you with the April numbers that Mike referenced just a minute ago, and we were working to get this together, so it's not in your packet, but I will get it out there to you so you'll have it. For the month of April, we brought in revenue $1,518,566.12 through premiums. We had expenditures claims, and these claims included prescriptions, the admin fee from Humana, and then the cost of the medical claims, and it removes any stop loss that we had already received in the month of April. And these these numbers came straight from Humana. So we had expenditures of $1,869,947.11. So we were short $351,000 for the month of April. We spent more than we had come in. And then year to date, and this is July 1, right? This is fiscal year to date, so this is July 1 of last year to where we are at the end of April. We had revenue of $14,243,168.88, and our expenditures so far been $16,049,465.33. So that puts us at $1.8 million short year to date. Now, included in your packet is that budget report as of March the 31st that was presented at the budget workshop, and I wanted you all to have this to make sure, because I wasn't sure who all knew or what you knew about rates. So you have in there the information that the rates are from active employees, and then also the retiree premium, which it's the same, but wanted to make sure that there was that distinction there. And then you have the health insurance fund breakdown, where you've got the premiums on the top and then the expenditures on the bottom, and there is a difference there, so you can see what those numbers are. And I think I've talked to most of you individually where we kind of went through this and explained what has happened, but the budget committee, I believe, has made the with the budget, they've put the shortfall there into the fund on the county side, and it will sit there until this body is able to act and decide how we're going to proceed going forward, at which point then, Mike, correct me if I'm wrong since you're on the committee, but then the committee would reallocate the money where it needs to go appropriately. Is that correct?
Based on, any plan design changes that are made between now. But we have to balance the budget, and so that's the reason the move was made to fund the shortfall. So this is just a recap, just so that you start to see that these numbers continue to compile the way that they are. $351,000 shy for April to be able to fund the health insurance claims, and $1.8 million year to date, and projected 12 months, almost $3.1 million. So those, those are the numbers, and so that's part of the issues that we have to address as we look at fund plans and those changes that may occur in what Cole has brought before us for consideration, and the information that'll be forthcoming, hopefully a lot at the next session that we have. Is that all there, Jenny? Okay, thank you. Okay, next item on the agenda is for input on any items that are not on this agenda. Is there anyone? Okay, given none, I'll take a motion to adjourn.